What's happening, guys? Hope you are doing well. I wanted to spend a few minutes kind of going over a question that's come up a couple of times, both on the real estate side and some client activity that was asking about this. But it has to do with the debt ceiling. There's a looming date, June 1st of 2023. Congress gets to vote on whether or not they're going to raise the debt ceiling. So what does all that mean? How does it impact mortgages? How does it impact, the real estate world, housing, et cetera? Is it going to make us crash? Is it going to make us, inflate to some crazy levels? Let's take a kind of a quick deep dive into it. You can see I've got an article here pulled up from Zillow, and this actually does a really good job kind of getting into the technical weeds of it. What my intent is I'll send you a link to this. I'll put it in the description, but then maybe just kind of break it down in a simple way so it's pretty easy to understand. But essentially, it's also really important to kind of frame out that in the history of the United States, there's never been a default on sovereign debt. So the chances of this kind of happening are pretty slim. It's most likely that Congress will raise that debt ceiling again. I remember when I was a kid, seeing some of the numbers were, in the trillions. It was like 6-7 trillion. Now it's like $34 trillion, and so when you're a child, you're like 7 trillion, so much money. 34 trillion now, that you're a grown adult, it's ballooned over time. And so that's just a result of, this isn't the first time that any of this has ever happened. This has happened before, and they've essentially raised it. But if they were to default, here's exactly what would happen. In short, you end up with higher mortgage rates. Here's kind of a quick little modeling behind it. Think of what happened with SV Bank and a few others where they asked for their payout, right? The consumer comes in and says, hey, I want to get my payout. I need that money, but then that money's been already invested somewhere. So they have to sell off those mortgage-backed securities or these US Treasuries or what have you to raise capital to pay that payout. That's essentially what would happen on the default. They need to pay out these yields, these US Treasury bills that are due for a nice spread, a nice payout to whoever invested in them, and they wouldn't have enough money to do so. So they'd have to sell off other securities in order to do it, other assets to do it. If they did that, they would essentially flood the market with a ton of mortgage-backed securities, and they would do it at a worse price than they probably should. It's not the optimal time to do it. And so it dilutes the value of things. And so you see these in the modeling here, you see mortgage rates kind of jump up. Here we are kind of in the low to mid 6s. The forecast would be somewhere in the low to mid 8s in a very short period of time. It would be really a massive shock to the housing market. It'd be a massive shock to us on the mortgage side of things. It would essentially turn buyers into ghosts where they just don't want to do anything because their borrowing cost would go up an estimated 23%. It would really kind of slow everything down almost to a halt. The other thing that happens is because it's government spending, any federal or state employees would end up with furloughs, maybe layoffs. They would have kind of a widespread slowdown on contracts getting renewed and things like that. So imagine all of the places that are tied to government spending getting completely either shut down or significantly reduced or just put on pause for a while. That would lead to massive unemployment. So you'd have unemployment go from like the mid 3s all the way up into the 8s. That would really, again, have a massive impact on housing, would slow things down. In the long run, it helps, again, on the modeling, you can kind of see this spikes and then starts to come back down from a rate perspective. It would help because we would accelerate the pace in which we're going to hit recession because we have these massive layoffs and unemployment goes up really fast. We end up in recession a lot quicker than we either already were, or it accelerates, kind of what we are already experiencing from a recession standpoint. Recession will bring inflation down and then interest rates will come down over time, but it's going to take a little time. It'd be kind of a huge spike and then a drop and then kind of gradually over time, according to the modeling. The other thing is, so what does it do for housing? So housing, again, the demand for housing really kind of shrinks. We already have low inventory, so the activity level on housing would really be reduced, somewhere about 20-23% according to some of the forecasts, and it would drop off. So you wouldn't lose a ton of value. You just wouldn't have as many sales going on. There's still going to be people that get divorced, die, have to relocate, and so because of that, there needs to be a sale, and there would be a sale, but there wouldn't be as many. Hey, I want to move to the other house because it's nicer, or I want to upgrade my house because just be nice to have a little bit more space. Those sales would really be put on pause more so than they already are because interest rates are significantly higher. And again, as rates start to improve a little bit and start to fall off of that initial spike, they would start to come back. You can kind of see that here. So this would be kind of modeled after some of the initial spike. There'd be a delayed effect on the demand, and then it would start to come back as rates start to improve a little bit over time. You end up with not a massive decline in house prices. You actually end up with a moderate adjustment higher. These would be your home value increases. So you probably end up in the year, maybe another percent and a half higher in your home value. So it would be a very modest improvement over time. But it wouldn't roll back. It wouldn't drop off the face of the earth. You're not going to see your house go down in 30% in value or anything like that. So just to kind of dispel any kind of fears that might be there, I wouldn't anticipate housing like really dropping off the cliff as a result of a default. The reality is that if the debt ceiling is raised, then we go back to the fundamentals that we've been kind of looking at from an inflation standpoint. What does that do to interest rates, and what does interest rates do to the demand and to the pace in which we're selling houses? And so there's really no major risk for housing. It would slow the pace down. You'd have less sales if they defaulted, but if they didn't default, then we actually see the pace increasing a little bit. So we actually see more sales happening, not rolling back. We actually see more appreciation, not rolling back. And then the borrower activity kind of gets reignited as we start to see interest rates come down a little bit over time. But between now and June, it's going to be a little bit rocky. So just giving you guys kind of a heads up out there, what to expect, some things that you may want to look out for on your side, and some stuff you might want to talk to your clients about. All right, guys, I hope you are doing well. Let me know if you have any questions, and we'll talk to you soon.